Hello, Eric. How are you?
Morning, Adam. Good. How you doing?
Everything's good. I had an interesting week last week. I went on the road to visit accounts in Texas. Spent 4 days there visiting. Actually, I think 3 days visiting the four cities: Dallas, Fort Worth, and then I scooted on down to Austin, and then San Antonio and Houston. So I guess that's five cities. Enjoyed it. It's good to meet with people. Zoom does a great job of allowing us to communicate readily with our accounts, but there's nothing like the personal touch and having a personal discussion. So I enjoyed that, and it coincided with the end of Taylor Swift's Eras tour. I know you're upset about that. But
Yeah.
every good thing has to come to an end. And she did her last gig on this Eras tour in Vancouver on Sunday. And then I did my Roaring 2020s tour, started it in Texas. We'll see. Maybe we'll carry it on for the coming year. Anyways, Eric, it's kind of chilly here. It looks like you're kind of bundled up. How's it in Santa Monica?
Cold mornings,
Well,
but
morning.
it'll warm up.
Yeah. Well, after Texas, I took a flight over to San Diego and I gave a talk at the Neri conference, National uh, Investor Relations Institute, I guess they call themselves. Had interesting conversations with these IR people. They, I guess, over the past few years have had to deal with questions of ESG and things like that. Maybe that'll be less of a concern up ahead here, given that things are changing in that regard. But that's not a subject we usually get into. Let's talk about the subjects we do get into. A lot of interesting things going on here. A lot of bullishness. That's kind of making us both a little bit queasy. It's always better to be have a market that's climbing a wall of worry, but this one seems to have run out of things to worry about, or at least that's the way it's performing. When I went to Texas, there are plenty of concerns, of course, about Trump's policies and how they might interact. One analogy is like it's giving a sick patient several different kind of medications to deal with that, and without looking at the computer to see how they interact. So I guess there could be unintended consequences of all these various policies between tax cuts and deregulation and tariffs, and then the impact that all might have on the deficit. So we'll be certainly staying on top of it. And then, of course, there's always our friends at the Fed. We like them a lot because they give us a lot to write about, and we do need subjects to write about, Eric. So the Fed's never short of things to comment on. And so I'll ask you to say some things about that. Why don't we just start out with that, Eric? What are you thinking on the Fed here? They're going to meet on December 18th. Before that, there's the CPI. Right now, the last we're in the blackout, so the last word we heard from them was they seem to be indicating that they're going to go for 25. But let's see what the CPI is. Eric, what if the CPI turns out to be a little bit of concerning? So I think you said it might ruffle the dove's feathers over there. How are they going to convey that to us since they can't talk publicly?
Yeah, so the base case, at least for the market, is that they cut 25 basis points. If you look at the CME Fed Watch tool, it's like nearly 90% odds of a cut, but they're in a blackout period. So the way they've conveyed, policy changes during the blackout was through Nick Timiraos, my former colleague at the Journal. I'm not totally sure if they're willing to do that at this point, especially given how committed Powell's been to dovishness, but we had a pretty good labor market report. I guess they can point to rising unemployment with 4.2%. If we have a good employment report and hotter than expected CPI, it seems really tough to cut another 25 basis points, but you got to watch for the Wall Street Journal, I suppose.
Yeah, well, I mean, The last we heard from Powell was that there should be a no rush to lower the federal funds rate. I took that
Yeah.
as some kind of warning the markets that not that it's not a foregone conclusion that they're going to do 25, and yet kind of the market's still stuck with it. I mean, it's conceivable. He thought just saying that would be enough to calm the market's expectations, and then they went into blackout, so he couldn't follow up with another comment. But look, you and I have been on the side telling the Fed what to do, and the Fed just won't listen. We've been in the camp saying that the Fed there really should be no rush to lower the Fed funds rate, and the 50 basis points in September 18th was about 25 basis points more than we thought was necessary, but then they kept going, and so now we're got 75 basis points as how much they've cut, and the markets are expecting there might be one on December 18th. So that will be a full point. I mean, there's nothing particularly grim or awful about what they're doing. It just increases the odds of speculative melt up in financial markets, and then we'll have to deal with the consequences of that. Bitcoin at around 100,000 and Nasdaq getting close to 20,000, and the mega cap 7 continuing to do very well. Even Kathy Wood's ARC companies are doing well. The Russell 2000, and I think, Eric, something like 30% of the Russell 2000 companies that are losing money. For the life of me, I don't understand why everybody kind of focuses on the Russell 2000 when it's got all these losing companies in it. I much prefer the S&P 600, which is the small caps, and the S&P 400, which is the S&P mid caps, as indexes for what's going on with in that arena. And we're still seeing that forward earnings expectations have actually continued to be in a coma, just kind of flatlining for about 2, 3. Well, actually, since the Fed started raising interest rates. But that's another sign of a little bit of exuberance here, maybe bordering on flipping from rational to irrational. Is that the valuation multiple is really what's led the S&P 400 and 600 higher, unlike the S&P 500, which has had good solid increases in forward earnings and actual earnings. Joe Abbott, our colleague, informs me that we now on the computer, on our system, have updates for the third quarter actual earnings season. And we've got a record S&P 500 revenues per share, record earnings per share. So all that's looking pretty good. And the growth rate was 8% on a year-over-year basis, which is about twice as fast as analysts anticipated going into the story here. What are you thinking on the CPI up ahead here? Because that could ruffle the feathers. I like that expression that you came up with for of the doves at the Fed.
Yeah, I mean, just on a monthly change, it should accelerate. I know the Cleveland Fed nowcast has near a 0.3% increase month over month. So we have easy base effects, which boost the year over year read, but we're also seeing hot monthly inflation. So, I mean, if we have like above 3% core CPI, it just seems like we could get super core CPI. It's closer to 5% before the end of the year. It seems like a
Right.
really, you know, tough environment to keep guiding dovishly. Actually, the NFIB small business survey comes out tomorrow, but the labor market component already came out, and plans to increase worker compensation over just the next few months surged in November, way higher, one of the highest readings over the past few years. So I think we're seeing it already that, the labor market's heating up, wage pressures are still there. Super core CPI isn't coming down anytime soon,
Right.
it seems like.
What was there a job openings series in the NFIB?
Yeah, it increased.
It increased. So I'm puzzled why they always put out the labor components before they put the rest of it out. But hey, they're entitled to do what they want to do, and it's helping us write our story here about why the Fed may be being stimulating an economy that's doesn't really need any stimulating. That's great for earnings. But again, the issue is nobody believes that the valuation multiple is cheap here. It's clearly expensive, and we're now at the point where we and maybe others are doing what we always do at market tops and try to come up with explanations of why this makes absolutely good sense here. And it does to us. I mean, we've been in the no recession camp for the past 3 years, and we don't see a recession over the rest of the decade. It's not a guarantee. It's not a promise. It's nothing we can control. But we think if we couldn't get a recession with the Fed raising interest rates the way they did, if we couldn't get a recession with geopolitical crisis that didn't lead to some problems with oil prices, then what are we left with? I guess we're left with Smoot-Hawley and a tariff war, and we'll see how that plays out in the next 6 months. But we don't think it's going to play out that way. So if the market basically is getting comfortable with the idea that we're not going to have a recession for a while, then I think that explains why valuation multiples are elevated. Meanwhile, the Magnificent Seven remain magnificent, and we've been talking about the market broadening out. We still think it's showing areas where it's broadening out. The S&P 493, maybe the SMID caps, focusing on the S&P 500 and 400. But meanwhile, since Trump was elected, it's really been a Tesla. It's been a Tesla market. It's been an Elon Musk. The world's richest man just keeps getting richer and richer, and I think Tesla's up again today. So, we used to focus on Nvidia, and now all the action seems to be in Tesla. Eric, I don't know if you saw Eric Rosengren from used to be, I guess, at the Boston Fed. Retired from the FOMC, and he was on CNBC. And he said that if he was on the FOMC committee now, he would vote for a pause. So, but again, he doesn't count. We don't count. We'll see what happens here. But if they do go with a 25 basis points, I think you and I will have a little conversation about whether we need to raise our melt up probability from 25% maybe to 30%. Then we'd have to take it out of maybe the roaring 2020s and still leave us with 80% that we're in a bull market. But we'll see. We'll see how that plays out. The topic of the morning briefing that we put together for you folks is all about American exceptionalism, and maybe that's becoming a contrary indicator that we've been in Eric before you joined us in May, all the way back to 2010. Joe and I and Debbie and our whole team had been in the stay home camp rather than go global, overweight the U.S. rather than overweight foreign stocks. We weren't advising not to invest in the rest of the world, though we did for many years advise not to invest in China, and that turned out to be a fairly good advice. But the better advice was to overweight the United States, and now everybody's aware of just the extent to which the U.S. has outpaced the rest of the world. And when I did my meetings with Texas, all of them were scratching their heads and saying, how much longer can that continue? Wondering whether it's now time to overweight the rest of the world. And, we'd like to be able to look at the data and say that makes sense to us. But right now, that still does not necessarily compute. And so we're recommending overweighting the U.S. still. But let's look at some charts, Eric. Show everybody the charts we worked on anyways. So here we go. So this is the this is the charts for December 9th. That's today. This just shows that concerns that politics might affect American exceptionalism haven't played out. Doesn't really matter whether the White House is held by Republicans or Democrats. GDP has a long record of rising, and recessions can occur in either one of the parties' political control of the White House. Same thing goes for the S&P 500. So there's something beyond the politics of who's in the White House or Washington. And we've continuously pointed out that it's amazing how well the U.S. economy and the stock market do despite Washington's meddling, regulations, corruption, and so on. The U.S. economy does very well, and that's because there are lots of working stiffs like Eric and myself and you folks that just spend the whole day trying to do our jobs, and we do them well, and we try to do them better and better. Our productivity increases, and so the U.S. economy is exceptional, I think, because we have an economy that's basically still very much focused on entrepreneurial capitalism. There's still a lot of entrepreneurial juices in the economy that keep it growing. Not only do we have a very diversified industrial base in our GDP with world-class companies, including the Magnificent Seven, which nobody overseas has managed to duplicate. But we've got a tremendous amount of venture capital. We've got distressed asset funds. In other words, we've got capital markets that are very deep and support this kind of extraordinary strength in the economy. And under Trump 2.0, it's pretty clear that the president is going to use our economic power and do the best he can to increase our economic power as a way to project our power globally and for in pursuing American interests. It's different from the Biden administration, which was more kumbaya. Let's get together with leaders around the world and do things that are good for the planet and all that. Trump is a different breed of politician, and not making a political call here. I'm just saying that's the facts. It's a regime change, and it's different. And the focus is, fortunately for us, to promote the roaring 2020s. Scott Bessent, the nominee for U.S. Treasury, has indicated back in January, he wrote a memo to his colleagues in Key Square, quoting me, saying, Ed Yardeni's talking about the roaring 2020s. This is probably a scenario that Trump would like to have. I don't know. I didn't get a call to be U.S. Treasury Secretary. He did, but anyways, he liked the idea of Trump winning, and he bet on it in his portfolio. And now he's obviously it's going to impact his professional resume, his career. Anyway, so the stock market's already figured out that we've got a great high-tech sector. This is S&P 500 information technology and communication services. It shows that the capitalization ratio now is 40% of the S&P 500. That's about the same as it was back here. So isn't that too frothy? And the answer, well, not as frothy as it was back here when the earnings share was down around 24%. Now, as you can see, it's more like 35% and rising. This is the chart we've been showing you on a regular basis since 2010. It shows the extent to which the U.S. MSCI has outperformed the All Country World ex-U.S. MSCI, and it just keeps going and going. This makes us a little bit nervous when we see something going straight up like this, but it's justified by everything we're looking at. This is just another slice and dice of the performance of the U.S. In U.S. dollars for U.S. dollar investors, of how our market has done since 2010 versus the rest of the world, and clearly we dramatically stand out. This just shows the market capitalization relative to the U.S. relative to the world. And again, you can see basically the same story here. Europe has lost a lot of relative market cap. Japan has been gradually falling as well. Back to the entrepreneurial capitalism ID. I wrote a book a couple of years ago called In Praise of Profits, and it was very much focused on the U.S. economy's entrepreneurial capitalistic foundations. Not crony capitalism, but entrepreneurial capitalism. And here's a good chart confirming that. We're looking at something almost like 30 million sole proprietorships in America. That's the total tax returns of companies that or individuals that file as sole proprietorships. 30 million is a a huge number. And then when you look at the income that these proprietorships generate, it's up to $2 trillion, which again is a lot of money. And then this is an interesting chart. I'm sure you've all seen charts of business applications, companies applying to be businesses. We just simply took the 12-month sum, and COVID really led to a big increase in business applications. And on a 12-month basis, 5 million companies filed to be businesses. So that's a big number, and it certainly would explain why the labor market remains strong. So, Eric, I'm going to segue to you to tell us here about the labor market. This is labor force versus employment. Tell us a little bit about why are we seeing this kind of red line, which is household employment, going flatlining, whereas the payroll keeps rising.
Yeah, so I mean, you could almost think of it too that they're just kind of coming closer together after there being a gap and payroll employment's catching up. But household employment captures everything, right? Like, people at home, homemakers, agrarian, like farm workers, etc. So all the growth in sole proprietorships and business growth since the pandemic, if you think those people are incorporating as businesses, right, they're going to be counted as new payrolls, whereas they were already counted in household employment. So you won't see that growth there, whereas you'll see new payrolls showing up. But yeah, I think payroll employment is much closer to the actual reality, and that's what we think. Also, if employment was actually down 750,000 people over the last year, I think wage growth would be much softer, and it's clearly not. So yeah, I think payroll growth is just it's hard numbers versus calling people on the phone, getting them to answer online surveys.
Yeah, I think we all know, and you and I both work from our home offices. Do you get a lot of robocalls? I get at least three or four a day.
Yeah, I get a lot.
Yeah, so it's the trick is to not to hang up on people that actually are important. That occurs every now and then. But yeah, I think it may very well be that if more and more individuals have their own businesses, and instead of being kind of self-employed and they just pay themselves, they filed as proprietorships, that they would show up in payrolls. They would not show up in the household survey. At least that's the way it's described. And you can check it for yourselves, folks, in the payroll in the employment report. This is just another slice and dice of it, and shows that if you take the ratio of payroll employment over household employment, it's been below 100 forever. And again, that's because the household includes self-employed and lots of other. But household includes the number of people that have jobs, whether they have one, two, or three jobs, doesn't matter. So it's the number of people that have jobs, whereas payroll is the number of people, is the number of jobs. So we're counting jobs with payrolls, and yet still that number, that ratio was below 100. But you can see it's been trending up. So something's funky is going on here, especially here since the pandemic. You see that's really increased. So Eric, I think one of the rules you learned from me when you joined us is that any data that supports our story is good data, and any data that doesn't support our story is bad data. So household is bad. Pay no attention to it, folks. Keep walking with payrolls. This is Eric. Tell us about the what you're seeing in the earned income proxy.
Yeah, so I actually saw a decent amount of people say the employment report was soft or worrying, which didn't show up in our data, at least. Our earned income proxy, which takes the work week or the increase in hours worked, it takes nominal wage growth, as well as the increase in payroll employment, increased 0.8% month over month in November. So that's pretty strong. And we're also, you get 2-3% inflation. It's still pretty good, or like 0.2, 0.3% month over month inflation. That's still pretty good real growth in incomes. So yeah, we're seeing, pretty strong income growth, and that should support consumer spending, especially into year end.
And that's aggregate weekly hours that goes into that. So it's aggregate weekly hours times average hourly earnings. So wages times the number of people working and the length of the work week, and that's at an all-time record high. It tends to zig and zag. So I guess the next thing it's going to do is zag back down. But the trend is definitely into record high territory. This is the average hourly earnings, all-time record high. Um, and Eric, what are you seeing here in the payroll by selected industries?
Yeah, I mean, it was pretty broad based. Retail trade sagged, but I like there was some funkiness with Thanksgiving, being later. That'll probably jump back up, especially with holidays coming up.
That's with
But
retail sale. That's with the
yeah,
retail trade, right? Yeah.
yeah, but I mean, it's been the same, few categories: healthcare, leisure and hospitality, government, which we've mentioned before. But if you're worried about like Doge taking out a bunch of federal employees, like it's really been state and local growth. So cops, firefighters, teachers, stuff like that. So yeah, it's been a lot of the same areas.
And production, the data suggests this is manufacturing aggregate weekly hours. That uptick, it still looks like it's another flatliner. It's amazing. There's a few of these things like household employment and this one that are flatlines, and yet the economy continues to crank out good GDP growth. Just again showing the diversity and resilience of the overall economy. It can withstand some rolling recessions without going into a recession overall. This is just the growth rate of the civilian and labor force and the working age population. And you can see that's slowed down here. Taking the year-over-year percent change in the 12-month, it's 0.7. Real GDP is the growth rate in the labor force, which is 0.7. That's pretty weak. But productivity has been the offset. And so we've seen a lot of growth in productivity, and that's been our roaring 2020 scenario. The seniors are retiring. That's one of the reasons that the labor force is slowing down. Um, and presumably, these people were pretty experienced, and maybe that should be a negative for productivity. But maybe companies already know that and are taking their younger workers and augmenting their productivity with all sorts of innovations, technology, and so on. But this shows that we got more people retiring, and that's actually been a positive story for us on the consumer because we've been pointing out that most of these people are baby boomers, and the baby boomers are sitting on very large nest eggs between what's the real estate value and portfolios and equities. Eric, so what's the bottom line on the latest Atlanta Fed data?
Yeah, hot, strong. It looks good. 3.3% real GDP after some pretty strong quarters earlier in this year. That the bottom segment of that chart is consumer spending or real personal consumption expenditures. Pretty hot, near 3.5%. The Fed likes to quote, real final sales or final sales to private domestic purchasers, but that all looks above 3%. So we're set up for something pretty good.
Yeah, and meanwhile, consumers are buying cars. They love their their light trucks. You can see light trucks spiked here. I think there was some year-end inventory clearance that went on, but consumers demonstrated that give them a discount and they will shop. So Eric, why don't we go back to the this view and I see we got a couple of questions here. Why don't you field them?
Yeah, we'll rattle them off real quick. The first one is on Syria. So any thoughts on that vis-a-vis geopolitical risk or oil?
Well, I think the initial reaction has to be that the overthrow of Assad demonstrates just how geopolitically weak Russia and Iran are right now. There's Russia obviously is being weakened by this war with Ukraine, and that's where their focus is. So they weren't able to do much to bail out Assad other than let him land in Moscow. And now, of course, there'll be a price for it. I think Assad's going to be much poorer once Putin gives him the hotel bill for staying there. So whatever billions Assad has squandered away somewhere, Putin's going to take away from him. But that's just a sideshow to our conversation here. With regards to Iran, My sense is that when Biden told the Israelis not to take out any nuclear facilities and not to take out any oil facilities, the Israelis said that's fine with them. They'll just stick to military facilities, and it looks like they probably took out a lot of the defensive military capabilities of Iran. So Iran's just kind of like sitting there naked without any defense, and I think the Russians uh, probably are in no position here to help them change that. And by the way, most of the defense equipment they had in terms of anti, uh, you know, to knock down jets from the sky. Most of that they got from Russia, and obviously it didn't work very well because Israelis sent 100 jets and 100 jets came back. So I think there's a possibility here that the uh, Trump administration might tell the Israelis, do whatever you need to do to finish this up with Iran, and it may very well that there'll be one more significant strike on nuclear facilities. Right now, the Israelis have been bombing Syria all over the place, uh, trying to take out chemical facilities. So the Israelis seem to have an amazing intelligence to know where all the bad stuff is, and they're taking it out. It's an ugly situation. I'm not telling you that there's a lot of horrible things, collateral damage occurring as a result, but that's the nature of war, particularly this war in the Middle East. Hopefully, it'll end soon. Hopefully, they'll defang Iran to the point where they can't go nuclear and they can't continue to support Hamas and Hezbollah. They've both of those regional substitutes for Iran have been defanged quite sharply here. Unfortunately, it looks like Syria turned into a Libya where just a lot of warring factions go to war against each other. So I don't think that has any impact on oil. It would be nice to have a stable Syria, but in the Middle East, you don't get what you wish for. You often get the nightmare, and that has just to be controlled.
Somewhat related, the odds of a stagflation scenario for the U.S. in 2025, and then the what would the Fed do in that situation?
Eric, I don't think we well, I guess we have that bucket that we got 80%, 55% roaring 2020s, and then we've got 25% that we've got the a melt up, so that's 80%. A melt up is not going to be the end of the world. It's just going to be a pain because we'll have to figure out when to get out and then when to get back in. We're actually expecting to see a significant pullback at the beginning of the year, mostly on rebalancing. No point in rebalancing now and with capital gains so high and taking the tax hits now. So I think there's going to be a significant amount of rebalancing in January, and if that's the case, we could have a correction. We could have 10 to 15%. I wouldn't go as to the extent of saying 20%, but it could very well be a rebalancing kind of situation, and we would view it as a buying opportunity. With regards to the last bucket, 20% is that's where we throw all the bad stuff in. So for a while, we've been talking about geopolitical risk, which seems to be a little less risky. We've been talking about oil prices going up. That hasn't happened in the geopolitical risk. Now, I guess we have the Trump tariffs as a potential issue. So I guess we'd kind of chuck stagflation in there, but we just don't see that. We think the economy isn't stagnating at all. It's gonna again, our base case is roaring 2020s, and in that scenario, we think the surprise could be that growth isn't just 3%, which is what Scott Bessent is aiming for, but we're already there. So we think it could be better than that on productivity. Go ahead.
So the next question was on the potential correction. So I'll go to the next. Hi, Ed. This is from Ava Sudol from Harvard Business School. Hope I'm pronouncing that correctly. Baby boomers are retiring and spending their accumulated wealth. Do you think they'll need to start selling their equity holdings, i.e. mutual funds, to fund their lifestyle since they're no longer working and saving? And would that put pressure on stocks?
Yeah, Eva, thanks for the question. Yeah, I mean that's a possibility here. I guess one could paint a bearish scenario where the baby boomers are selling their stocks. But meanwhile, the baby boomers are actually pinching themselves because now that they're retiring, not that they're going to have to live on their assets. Some of them, of course, can live on their income from interest and dividends, but that's probably a very small minority. A lot of them are going to have to start liquidating. They look like they're in no rush to sell their homes and take the equity out of that. So they could be selling stocks. But meanwhile, they're pinching themselves because the stock market keeps going up. So even if they're selling, it's just not having any impact on that. Why don't we take Sharon's question? What's that, Eric?
Yeah, Sharon mentions that she's seeing clients take withdrawals to buy new SUVs prior to possible tariffs next year. I guess it could be part of the broader thing, like would goods consumption rise in advance of potential tariffs?
That's a good point. I mean, it's conceivable that we looked at that auto chart and that some of that is consumers figuring that it might be 10% higher. But Eric and I are kind of thinking that one through. It's again, there's a lot of moving parts in these things. And so if the tariff is increased by 10%, but the dollar's already up like 5% or, goes up 10%, then it's kind of a wash in terms of the price impact. So I don't know. I don't know if consumers, generally speaking, are, are, are gaming that, but it's conceivable, in which
Mhm.
case, there'd be some weakness in car sales in some other areas. But all in all, we're not expecting that the tariffs are going to have a meaningful impact on inflation or the economy. Eric, thanks for joining me. All of you, thanks for joining us. And we'll see you again next week. Have a great week.
Thanks, everyone.